Medical Properties Trust Stock, ticker symbol MPW. This stock is up 6% year to date, which is also driven by the whole GameStop situation. On the 9th of May, MPW presented earnings, what I missed on both the FFO and revenue. But most people love MPW stock because of the dividends. But they cut the dividends not too long ago. And in my latest video about MPW, I warned people about this stock, since I think they might cut the dividend in the near future. Maybe not this quarter or the upcoming quarter, but I think it is not a sustainable stock. But more on that in a minute. I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does MPW do? Medical Properties Trust is a healthcare facility REIT. The company owns and leases healthcare facilities. The vast majority of medical's revenue is generated in the United States. MPW has 436 properties within their portfolio, across multiple countries and states, with a total of 53 operators. Right off the bat, the debt ratings aren't looking too good, with -B, so that's something to keep your eye on. I prefer A ratings here. Diving into the results, we see that net loss income was reported at $735,625,000, which of course is not looking any good. But there was a $693,088 impairment charge resulting in a positive normalized funds from operations. But still, it is down year over year, so that's definitely something to keep your eye on. Looking at the per share data, we see that again net loss income per share is looking terrible, but the impairment charge came in at $1.16 per share, resulting in a normalized FFO per share of $0.24, down big time year over year. The good part is that it seems that the $0.15 dividends seems to be covered by MPW with this $0.24 FFO. Looking at the net debt to EBITDA, I also get worried. Right now it is reported at 8.8, which is really high, even for a REIT. I prefer a range of 5 to 6.5 in most cases, so definitely keep an eye on this number as well. The good part is that 89% of the leases expires after 2033. This is looking pretty good to me. Looking at the asset breakdown, we see that general acute care hospitals represent 64% of the portfolio, behavioral health facilities 14%, and from there it breaks down in smaller pieces. Looking at the operator breakdown, we see that Steward Healthcare represents 80.5% of the portfolio. Circle Health represents 12%. Both numbers are too high in my opinion. I prefer a maximum of 10% here, so this is something to keep your eye on in the future. Looking at the geo breakdown, I think everything looks good, with Texas being the biggest state with a total of 8.2%. In total, US represent 61%. Europe and the UK represent 39%, of which UK is by far the biggest. Again, this is something to keep your eye on. Another thing to keep your eye on is the revenue that is declining, while expenses are increasing. This leads to lower margins in the end. And now that we know more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. MPW is a 3.22 billion market cap company. PE ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. Right now it is sitting at almost 26, indicating they might be massively overvalued. Later in this video I will show you my 3 price targets for MPW stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 1.48 billion, and in this graph we see that revenue used to go up, but it is coming down big time lately. We see that margins are also going down big time most recently, and this is not looking any good. I also showed this a minute ago. It's not only the whole situation with Steward Healthcare, but expenses are increasing while revenue is decreasing. EPS is going up in the long run. It is not really steady and consistent, but that is very common for REITs. However, the most recent decrease is something that of course worries me a lot. Analysts expect that in the coming years EPS will go up to $0.35 per share, with of course some problems in 2024 and some recovery in 2025. However, from 2026 on it's again to expect a decrease. For the revenue it is not looking any better, with the analysis expecting almost no growth on average. The company is expected to have a revenue of 1.13 billion in 2028, which is only a 10% increase versus 2024. Return on assets is sitting at minus 8%, which is a really bad number. Return on equity is also looking really bad. And the most important number, return on invested capital, is sitting at 0.37%, which is a low number. It's also lower versus the 5-year average, so that's also something that I don't like. Current ratio is at 3.10, which is a high number, even for a REIT. So keep an eye on this number since it is increasing. Right now MPW has 10 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. MPW has 224 million in total cash, so they can't pay down a big chunk of their debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run, which is a great thing. And to be honest, this surprised me a little bit. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, this is where things get interesting. MPW is known for paying dividend yield around 15% in the recent years, which is an insane amount of course. But not too long ago there was a dividend cut. As of right now dividend yield is at almost 11%, which is still an insane number. Annual payout is at $0.6 and payout ratio is looking pretty decent at 60%. However, keep in mind this is mainly supported with the impairment charge, which is not really a sustainable way of paying dividends. There is no growth streak to report, so that's why we see negative numbers here. Looking at the dividend estimates, we see that it is expected to go down from here. To me, this is also not looking any good. And with that being said, how about the historical returns? Was there any value in holding MPW over the past couple of years? I decided to compare MPW stock with the overall market, in this case the S&P 500. On the 5-year chart we see that MPW underperformed the S&P 500 big time, with a minus 57% return including dividends. The S&P 500 is sitting at 102% return. On the 1-year chart it looks pretty similar, with MPW sitting at a minus 35% return. The S&P 500 is sitting at a 27% return. On the 6-month chart it is getting pretty interesting, with almost 16% return for MPW, while the S&P 500 is sitting at 17%. On the 1-month chart it is finally MPW that is beating the S&P 500 big time, with a 25% return versus 3% for the S&P 500, mainly driven by the GameStop situation of course. So bottom line, MPW underperformed the S&P 500 long term, but in the short run they are going up big time. So could this be the perfect time to buy MPW stock? Well, let's check the 3 price targets that are created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 0, 2 and 4%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 36, 38 and 40%. And for the free cash flow margin I'm putting in 36, 38 and 40% as well. For the PE ratio I'm putting in 5, 6 and 7. For the price to free cash flow I'm putting in the same numbers. My desired annual return is 15%, since I can get an easy 10% average annual return with owning an ETF. Usually I put in 12.5%, but I want to build in a higher margin of safety here. Right now MPW stock is at $5.37. I hit analyze and we see a lot of red numbers. And since this is a REIT I'm only focusing on the discounted cash flow value. We have a low price target of $2.86. We have a mid price target of $3.51 and we have a high price target of $4.33. And to me the mid price target is the most justified here, indicating that this stock is overvalued based on these numbers. What do you think is the most justified price target? Let me know in the comments down below. My final conclusion on MPW is that it is my final warning. Dividends are getting cut and maybe soon there will be a dividend cut to 0. It's just not worth the risk. So please be careful when you decide to invest in this company. There is a lot of debt, revenue is declining big time and margins don't look good either. The only thing that I do like is the current free cash flow growth. But there are better companies out there that have the same free cash flow growth. So it doesn't feel like a justified reason to buy this stock. For now I'm skipping this stock and I will closely monitor the dividend situation. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.